Okay, so we want to start off with a disclaimer. So first of all, hate to begin with this disclaimer, but such is the world we live in. This overview provides general information about a specialized non-grantor trust we refer to as a dynasty spendthrift trust. Our objective is to help you understand how the trust works and the benefits our decades of experience with trusts in general and with other asset protection and tax mitigation tools and strategies lead us to believe it can provide. We are not providing or attempting to provide legal tax advice by making this overview available to you, nor does the overview itself contain sufficient information to constitute tax or legal advice. The best way to set guidance on a specific tax or legal issue is to consult with an attorney who is licensed in the state in which your issue exists and who is also admitted to practice law before the United States Tax Court. If you will provide such an attorney with specific information about your objectives and the factual circumstances related to your issue, he or she will be able to advise you competently and, if appropriate, even provide you with a written tax opinion letter before you proceed with the execution of any particular plan. It's easier to fool people than to convince them they have been fooled. And unfortunately, my job is to show you how you've been fooled. So this is a red herring. Red pills, blue pills, it's kind of like the wake, the unawake. No, the whole game is different than you've been taught. And it doesn't matter which pill you take, you're still in the wrong game. Very insidious. So you're schooling for 12 years. Then if you went to college or university and masters and everything else, they taught you the wrong rules. And we're going to be teaching you a different set of rules. In our world, the game that the winners play is chess. The game that everybody's been taught to play is checkers. And I want you to keep this in mind as we go through the presentation. There are very specific rules for checkers. There are very specific rules for chess. If you're in a checker tournament, well, let's say you're in a chess tournament and you want the bishop to go horizontally or vertically on the board, you'll be disqualified. And when you learn the game of chess, the real game of the world, you're going to have to make sure you're going to have to be very vigilant because you're used to the checkers rules. And if you apply the checkers rules to the game of chess, you're going to lose badly. All right. So you've been taught the 40-year plan. Everyone's been taught it. Get a job, work 40 hours a week for 40 years, get a pension. And if you're entrepreneurial, you'll go, yeah, man, I know the 40-year plan and I'm out of it. Yeah, you replace the 40-year plan with the 60-year plan. Start a business, work 60 hours a week to get it going. Maybe in 60 years, you'll be able to stop working. And all the while, you're vulnerable to the tax man. He wants his cut, and he watches entrepreneurs like a hawk, often harassing him just because. I know many entrepreneurs, they got phone calls from the Canadian Revenue Agency, which is the Canadian version of the IRS, and from the IRS, and just made up stuff. And then their accountants didn't know what was going on. They all said, hey, this isn't happening. And after months and months of harassment, they said, I just wanted you to know that we're here and we're watching. Thank you very much. Lawyers also have a close eye on you. The US is the most litigious country in the world. Some outrageous number of lawyers to people. And they're always on the alert, waiting for you to screw up and swoop in and take all your hard-earned wealth. So there's two parts to life, as you know, if you just sort of look generally in terms of finances, right? The first part is you make some money. Second part is trying to keep the money, not the money you spend on food or accommodation or gifts, but the money that the government, the tax man, lawyers, scammers want to take from you. And they take a lot of money from people. All right. So wealth puts a second target on your back. The first one, of course, being the tax man. The second one is lawyers. They see you as easy pickings. You go and you make, you get a lawsuit, and the question is, well, do I want to spend, $20,000 defending this lawsuit, or do I want to just negotiate? And of course, and do I want to go through the pain of doing all that and the time of doing all that? And of course, the answer is no. And so usually they get what they want. And a recent poll of lawyers suggested that lawsuits are going to skyrocket in 2021 and beyond. And that is, in fact, what we're seeing. In 2020, lawsuits, federal level only, not state or provincial. Civil cases up 16%, immigration 28, disputes 16, ADA cases, that is Americans with Disability Act, 63%. And on she goes. All right. So today you're going to discover how to protect your wealth, the safest ways to keep the taxman off your back, and how to leave a legacy for future generations. You're in the right place. If this training is exclusively for entrepreneurs that have high growth companies and are looking at protecting their wealth. This training is perfect for investors who want to keep their profits as long as possible. And if you're worried about your exposure to the tax laws of the United States, you're in the right place. And if you want to build real long-term wealth for your family and descendants, this is the place to be. And there's a saying: short sleeve, long sleeve, short sleeve. And what it means is, and a great example would be my family. My grandpa wore short sleeves. He was a farmer in the prairies of Saskatchewan, and he would grow wheat and shovel wheat into bins. He grew his own food. He had some turkeys. And so he worked hard from before sunrise to sunset, putting food on the table for my parents, my mom, my dad in this case. And my other grandpa did it for my mom. And they didn't want that for their kids. So they worked hard, they saved hard, and they were able to put their children who wanted to go into university. My dad got an accounting degree, became chief financial officer of a large multinational grocer, and he had long sleeves because he wore a suit and tie and he worked in a nice air conditioned office. And of course, he didn't want his son to go through the things that he went through growing up. So we had, nice TV, nice house. Everything was kind of, didn't really have to work. And of course, what normally happens is the third generation has no work ethic, doesn't know what to do, has no understanding of life, has been totally pampered and spoiled. And when they're on their own, they can't make anything work. So they go back to working in the fields, digging ditches, that sort of thing in the city, and are back in short sleeves. And I'm wearing short sleeves because I'm in Medellin, Colombia, and it's warm. But that's the analogy. So why is it so difficult for families to keep wealth in the generation, generation to generation to generation, not just, one or two generations, but 10 or 15 or 20? And when we look at dynasties like the Bush family, the Kennedy family, the Vanderbilts, the Rothschilds, the Rothschilds and some of the European families have had their wealth kept in the family for centuries, like 8 centuries, 6 centuries, right? Why is that? That's one of the things we're going to be talking about. So before we go any further, I don't want to waste your time. Do you qualify, like what I'm going to show you, do you qualify to participate in it? So if you have capital gains over 300K, do you have an estate over 3.5 million? Do you have passive income over 100,000? Do you have business income over 250? And if the answer is no, then you're welcome to stay and watch, but we're not really going to be able to help you. So set aside the next 45 minutes, blah, 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 blah. And who are we? So we're led by Dr. Gina Gaudio Grace. She's the founder and senior partner of Abundance Group Trust. She's a graduate of Notre Dame. She studied trust for over 30 years. She's a certified wealth planning strategist, She was the lead note editor at Notre Dame Law Review in the 1990s. She's a retired attorney, 20 years experience as a business strategy and leverage consultant. And I'm your host. I'm Scott Patton. I've been studying trust for 25 years, and the team I represent has helped over 40,000 entrepreneurs just like you protect their assets. So to recap, your wealth has skyrocketed in value. The U.S. taxman wants your capital gains. Biden wants to increase capital gains tax to 40%. Taxman wants to impose additional inheritance taxes on your family. Lawyers want to sue you. Oh, yeah. And if you break any of the rules and get caught, which you probably will get caught, they're going to put you to jail for 5 years. So not a very pleasant situation. I don't know why I had that happy face there. So everyone's going to tell you there's nothing you can do but pay up. And we're going to show you that is not the case. You've been taught to play checkers when the real game is chess. And it's no wonder the taxman is about to knock over your crown. All right. So there's two types of wealth. There's the old wealth and the new wealth. And there may be people who have come into wealth recently. They can still be classified as the old wealth. Okay. So the way I distinguish the two is, people have put $20, $2,000 into Bitcoin a decade or two ago. It's worth $50 million. And they have no clue how to protect their wealth. It's in the Bitcoin, and they're hoping, everything will be fine. They're not really sure how they're going to get the money out without paying taxes, but that's new wealth, right? The old wealth is they've got it all figured out. They know exactly how to keep it, how to protect it, and they don't want you to know it. The old wealth sleeps well at night. There's been a whole bunch of bills that have gone through Congress or been put in front of Congress and the Senate recently. A lot of them have caused havoc and panic in the realm of real estate investors, stock traders, and these people have been really concerned about what's happening. And the old wealth, they're not really concerned about it. And there's a good reason why. Who makes the rules? So let's take a look at JFK's niece. She's worth $100 million. And the International Business Times reported that the Kennedy's family's lasting wealth is attributed to actually two facts. Well, lasting to one fact, but wealth to two. One is he made his fortune in insider trading, which is now illegal. I wonder when they decided to make that illegal, probably well after Joseph P. Kennedy had made his fortune and he didn't want anyone else doing the same thing. And he tucked his money into dozens of trusts so that, first of all, Maria doesn't control the trust. She doesn't control the money. She's a beneficiary. And so you don't have to worry about someone with poor financial skills doing stupid things and losing $100 million. She gets to spend, she can ask for money and she can get it and she can buy the nice dress and everything else. But that is protected for her children and her children's children's. So who makes the rules? In 1913, the US government started taxing income of US citizens. Who do you think influenced what went into those laws and rules? Right? People who were elected and had, let's just say, some good relationships with people with lots of money who helped them get elected. But the US tax law is over 2,600 pages. The National Taxpayer Advocate noted that the tax code changed 4,600 plus times from 2001 to 2012. That's an average of once a day. Rules and regulations make up another 9,000 pages. So who has time to figure this all out? And if you want to hide something, where do you hide it? In plain sight. And if you've got to read 13,000 pages to find something, highly unlikely you're going to find it. Now, the Biden administration has a new infrastructure bill, and it's over 2,600 pages, as you can see in the picture. And it has an obscure section for tracking all transfers of digital assets. So now the IRS has a new tool to go after individuals who don't fully or accurately report digital assets on their tax returns. And of course, that's not just like your website or your ebook. It ends up being a lot of other things as well. And they want more. President Biden is proposing nearly doubling the capital gains tax rates for wealthy individuals to 39.6, which means that, and rather than waiting for the capital gains to be realized by the sale, it's possible it could be taxed in the year that it came up. So you bought a stock for 10 cents, it goes to um, a dollar, you made 90 cents capital gains, but you hang on to it because you think it's going to go to $2. But in that year, you're going to have to pay capital gains on the 90 cents. Now, these are all proposals. They may go through, they may not go through. That doesn't matter. The point is that one day they will go through. The bureaucracy does not change, and the bureaucracy wants this. The people behind the presidents and paying for everything to get, everyone to get elected and all the rest of it, they kind of want this too for the average everyday Joe, the new wealth. And if they're part of the old wealth, they know they don't have to worry about it. And you'll see why in a minute. All right. So if you love your children, you want to pass on your generational wealth intact. But your present estate planning puts a financial burden on your children and their children because they have to deal with probate. There could be inheritance taxes coming. And it's all about not letting the wealth, it's all about short sleeve, long sleeve, short sleeve but this time, instead of it being, your family that didn't teach you how to keep the long sleeves, it's the government cutting the sleeves, if I could put it that way. So all you're doing to pass on, so when you get like the IRA or the 401k, you're passing on tax obligations to your children. Doesn't seem like that at this point, but that's the direction that they're going. And someone's going to be paying taxes when the funds are distributed. And if it's not, it's great, it's not me, but now you've left a real pain for your children and your grandchildren, and I don't think you want to do that. And as I said, President Biden is looking at a 61% tax rate on inherited wealth. And one of the things to remember is, they talk about these things and it's only, someone who's got $100 million or whatever. And that's where it starts because, hey, I can't imagine ever having $100 million. But you have inflation, which means everybody's dollar value goes up, which means that over time that 100 million gets closer. But also it's like, it's 100 million that, we have a problem, we need some more money, let's make it 50, and then let's make it 10, and then let's make it 5, and let's make it 1, and let's make it 500,000. And before you know it, it doesn't matter what your estate is, you're going to be paying some tax on it. All right, so what's the secret? Inside, now this is the world according to Scott. This is all made up. This is fiction, but that doesn't mean it's not the way it is. Hidden in the tax laws and codes are short subsections which ensure the old wealth keeps its wealth. That in the beginning, the Kennedys, the Rockefellers, the Fords, the Carnegies, blah, 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 did everything they could to protect their wealth. They weren't going to let someone else take it. And today's guardian of the old wealth are right there. And they make sure that any laws that people try to put through that threatens their system doesn't get through. But also, they put other stuff into the law that makes sure that it protects them and keeps you from becoming part of the old wealth. So let's look at some of the things about this old wealth. And like I said, there are people that have just come into wealth recently that they know they're part of that gang. It's just that you and I aren't. So they own nothing. They control everything. So by the standards that we judge wealth, all the old wealth people are poverty stricken. And if you sued them, you would get nothing because they have nothing. Doesn't seem right. They play chess while you play checkers. And so here it is. You're playing by the wrong rules. You've been fooled by the system. And it's harder for me to convince you you've been fooled than for the system to fool you, and it's because your teachers weren't malicious. They were teaching what they had been taught, and they were teaching it from their heart. They believed everything that they said. When you're 6 years old in grade 1 or 8 years old in grade 2, uh, you believe what you're told. Why wouldn't you believe? And it's not until you get over 16, 17, 18, 19 where the brain is actually developed to the point where you can figure things out for yourself. But by then, you have this set of beliefs totally ingrained. Everything that you see around you shows you that that's the way the world is. And so you don't question it, but you're playing by the wrong rules. And if you're playing by the wrong rules, you have little chance to win. Until today. Today, you're going to learn the golden rules of the game of money. And the secret to success is to own nothing but control everything. The Rockefellers, one of the Rockefellers said it, and he was, they give you clues and they tell you because they know their system is so powerful that you will not get it. And if there's anything you learn today, learn this. The secret to success is to own nothing but control everything. So I have a Lamborghini. If I said to you, hey, here are the keys, go drive the Lamborghini wherever you want for as long as you want, no worries. Police pull you over and you say, this is my Lamborghini, you're going to jail because you just stole it, right? But if you said, hey, my buddy Scott gave me the keys, told me to drive for as long as I wanted. Hey, Scott, did you do this? Yeah. Okay, thanks. Well, Mr. Driver, continue on. No problem, right? You get the use of the Lamborghini. You don't own the Lamborghini. If you owe $200,000 and you're driving the Lamborghini and the police pull you over and say you owe $200,000, we're taking the Lamborghini, you go, whoa, man, it's not mine. What? No, it belongs to Scott. Oh, well, our documentation says we need to take stuff from you, not from Scott. I guess I can continue driving then, can't I? Yeah. So this is something that I really want you to wrap your head around. Would it be okay to live in a $3 million mansion that you didn't own and didn't have to pay rent? So the answer is yes. You're on your way. And would you say that is your mansion? No, never. So how can you control everything without owning anything? There are two structures that you need to use. First is a trust, and the second is a private family foundation. Let's talk about the trust for a minute. Trust is a contract. It allows a third party or trustee to hold assets on behalf of a beneficiary or beneficiaries. So there's a number of parts to it. There is a person the settler, who sets up the trust, who puts some money into the trust. There is the trustee who basically manages the trust, and there's the beneficiaries who get the benefit of the trust. So if instead of me, the trust owned the Lamborghini and you were a beneficiary and you were driving it, then that would be how that works. And let's say George is a trustee, he would make sure that, you weren't crashing the Lamborghini and that sort of thing. All right. So trusts will pay for all of your expenses except food, fun, and fashion. You have to pay for your own food, you have to pay for your own holidays, going out partying, whatever, going to the movies, and you have to pay for your clothes. Trusts can own houses, cars, boats, appliances, sailboats, pay utilities, pay education costs, and much more. Beneficiaries under 21 can have their food and clothes paid for by the trust. Okay, so you have a 4-year-old child, you can go to the grocery store, you figure out what food is for the child, what clothes are for the child, and the trust will pay for those, you'll pay for the rest. Now, private foundations are an independent legal entity set up solely for charitable purposes. This is to do good in the world, to leave a lasting legacy. It's a specific kind of trust. All right. Private foundations allow you to go on family retreats, which can be fun, paid for by the foundation. You have to understand that the family retreats are, the foundation has a purpose. And let's just say the purpose is to feed starving children in Kenya. Okay. You have to have an annual family retreat where the whole family gets together and discusses the direction. Okay. And maybe you've done such a good job that there are no longer starving children in Kenya, but they're in Uganda. And so your son, who's part of the family, or daughter, who's part of the family foundation, says, we should change and now we should do this instead of that. And so you come to that agreement and the direction of the foundation changes slightly. And you can do those retreats because you need to do them, because they need to be focused. You need to do them, together and not be distracted by everyday life. It's always recommended that you leave home and you do it somewhere else, because when you're at home, the phone rings, all these different things keep going on. So go to Disneyland, go to Morocco, go to wherever you want to go, and stay in a place and just really focus on the foundation. Travel for the business of foundation is paid for by the foundation. How trusts work, Chess 101. All right. So can you really move your assets and incomes into a private structure that defers taxes and possibly eliminates them? Yeah. Trusts are as individual as you are. We design business trusts, intellectual property trusts, personal trusts, crypto trusts, and more as demand and need dictates. We've been making trusts for a long time. So let's look at some general examples of trusts. Now, at this point, I just want you to get the idea of the trust, kind of get the big picture. When you look at this and then you sit down with your trust advisor and talk to them, they may be saying things totally different. Plus, things do change in trust, and there may be some, 100% deferred. No, it's only 95% deferred, or or these sort of things, right? So I want to say that the trusts are not there to eliminate 100% of your taxes. I mean, that may be possible depending on your situation, but it's not likely. Okay, but hey, if it can eliminate 90% of your taxes, then certainly it's something to look at. So, as I said, your situation is unique. What your trust advisor will do is design structures based on your goals and plans. Okay, this is just to give you some idea. So, if we have a personal trust and you have passive interest income, you can move that vehicle that's creating the income into the trust. And after a year, if that money goes to the trustee or the beneficiaries, then it can be taxed at the preferred tax rate, at preferred dividend tax rate. Okay. So in the trust, you have the settler, the person who sets up the trust, you have the trustee, the person that make sure everything is being done the way it's supposed to be done based on the rules and regulations and agreements in the trust. And you have the beneficiaries who, of course, benefit from the trust. We also have a compliance overseer who makes sure that everything is being done the way it's supposed to be done. Oftentimes, people who come into a lot of money or control a lot of money will bend the rules. So the trustee may, say, well, the trust needs to buy a car because I need to have a car, and they'll justify it. And the compliance overseer may say, hey, that's, not the way it works. And, hold, and then they can change the trustee out if the trustee is uh, insincere, let us just say. All right. So, for example, if you bought crypto at $200, you could sell the crypto to, oh, let's go back. You can sell the crypto at $200. Well, I don't want to say that anymore. You can sell the crypto to the abundance group, to your trust. Okay. The trust would set up a promissory note, a demand promissory note at 3% interest, or it could be 1.5% interest. It is set by the IRS. So I thought it was 3%. Someone else said it's 1.5. We would find out what it is, and that would be what the demand note would have. You pay interest, tax on the interest that you get. So let's say that you pull out $100, $103 after a year, 3% interest, you'd pay tax on the 3%. You would not pay it on the 100 because that's just your demand note being repaid. Now, when the crypto goes into the trust and has a present value of 200,000, it's quite possible that 90% of the capital gains, so if you sold 100,000, 90% of that 90% of the tax on the 100,000 could be deferred. In other words, you'd be paying tax on 10,000 instead of 100,000. Never ever gift anything to your trust. You sell everything to the trust makes a demand note, a demand promissory note back to you at the rate that the IRS says. If you gift anything to your trust, it's the same as trying to take the rook and go diagonally. If you're in a tournament, you get kicked out. Okay, so here's something that's a little more complex because there's a business trust. Let's say you have a business LLC, and in this case, you've got a sailboat that you charter, and you've got a roofing business. All right. So I'm not going to get into all the details, but the business LLC sells the personal trust with the promissory note, and the roofing company sells their stuff to the personal trust with a promissory note. The personal trust leases everything to the business trust. Okay. And so, and the rate is 70% of the business trust profit goes back to the personal trust in these payments. All right. So the personal trust has revenue investments. It owns the sailboat. It owns the roofing IP. It has your house, your car, because you sold them to it as well. And of course, it has a trustee, the beneficiaries, and it defers taxes on a lot of that income that's flowing through from the business trust. And in the business trust, after the expenses are taken out, it may have some net income, and that can flow back to the personal trust. All right. So you now have your trust, and you've decided you want a foundation. You can donate from the trust to the foundation. There's no limit. You can also accept donations from other sources, companies, trusts, other foundations, the government. And you have the grantee or project. So we want to feed starving children in Kenya, and so it's Angie in Kenya that runs that project. She gets the money. She starts feeding the children. It pays for family retreats. The foundation, generally speaking, has zero income tax, zero sales tax, zero capital gains tax, because it's a foundation. So here's a look at the trust and the foundation. So the LLC or you sell your assets, software and IP, physical assets to the trust. And the trust has beneficiaries. It has a trustee. It pays all children's expenses. So if the beneficiary is under 21, it'll pay all of those. And it donates over to the foundation. The foundation looks after. So the foundation or the trust, depending, right? Like if you donate the car to the foundation, and this is where everyone's individual situation is different, right? It may be better that it's in the foundation. It may be better it's in the trust. You have the same privacy and you have the same protection, asset protection in both places. But in this particular example, the software and the IP is in the foundation, the card and expenses are in the foundation, other assets are there. Your education is paid for by the foundation. It goes on family retreats, pays money to the beneficiaries, possibly the trustee, and of course the grantee. Now, regardless of whether it's in the trust or the foundation, money paid out is taxed after 1 year, is taxed at preferred dividend tax rates, which means there's zero tax on the first 40,000 for individuals, 80,000 for couples. This is the chess game. Checker game is if you got that money and it was not in a trust, you have a $12,000 exemption for individuals and 24 for couples. Okay, so in other words, if you're a couple, you can pull $80,000 out. You can be a beneficiary and receive $80,000 from the trust. So you've got to be careful how you say these things. After 1 year and a day, and it's tax exempt. So if you didn't have to pay a mortgage or rent, if you didn't have to pay for your car, gas, maintenance, didn't have to pay for painting a room in your house, you didn't have to pay any educational expenses for your children, you didn't have to pay for the boat that you like to ride around the lake in, you didn't have to pay for your, I don't know about your watch, you probably would have to pay for your watch. All you had to pay for is your food, new clothes, and some vacations. Could you do that on as a couple or a family on 80K, right? A year. Most people pay for everything and have no luxuries on 80K a year. So should be no problem. And of course, it all depends, right? I mean, if you're buying $10,000 suits instead of $1,000 suits, then yeah, that might not go so far. But it's way better than paying tax on 24,000, starting at 24,000. I mean, it's like 4 times more. So that's, kind of one of the advantages of playing chess. And I talk about this a little bit more later on, but that's one of the main that's an advantage, right? You've got all these things that can be paid for by the trust or the foundation. And when you pull out money, you don't pay tax until a far higher threshold. And so you can see how the average person, has a really hard time making anything go. I mean, you make 24,000, over 24,000, and it's taxed, right? And the tax rates that the chess masters pay is 15% and 20%. And I think it goes all the way up to 40 something percent if you're a checkers player. But we'll see that in a minute. But here we go, right? The top tax rate for checker players, 45% federally. It's probably 60 some percent when you add in the state, and even more when you add in the city. And chess grandmasters pay 20% federally. There's an inheritance tax coming, and 61% is what they say it'll work out to be. In other words, you're not going to be able to pass your wealth down. So trust defer may eliminate capital gains and other passive income taxes. Has privacy, asset protection, no probate or inheritance tax. When someone dies, they have nothing. They die poor. So hopefully the trust will contribute to their funeral. But there's no probate or inheritance because the person has nothing. In the private family foundation, it eliminates capital gains taxes. It has no income tax. It's tax exempt. You do not pay sales taxes. Adds to the tax benefit of your trust, and it's a charitable organization. This is not just about keeping money from the tax man. It's also about leaving a legacy for your children and contributing to the betterment of mankind. With your private family foundation, you can combine your for profit business with a nonprofit charitable cause. And this is one of the most powerful strategies you can use to grow your business, asset base, and change the world. You want to build wealth with purpose. And it's not just to have a nice car. So here are some do's and don'ts. And I want to emphasize this because, like I said, if you're in a chess tournament and you try to make the rook go diagonally, they kick you out. You broke the rules and you're toast. And we don't want your private foundation becoming toast. So do's: receive donations from your trust and other sources. You manage assets. You spend 5% on the foundation's goals. And you make sure all the filing requirements are done. Now, here are the don'ts. No self-dealing. That means no stealing. It's so easy to say, hey, I've got this card. It's the foundation's bank account. I'm just going to pull out $100, go for lunch. And then not keep track of it. And if you break the rules, you're out of the game. No bad investments. So when I come to you and tell you I got this bridge in Brooklyn, say, thank you, Scott, but no thank you. You make very conservative investments. No politics. No active ownership. I don't even know what that means. Private family foundations has a 70% better chance of accessing government grants than the average person on the street. You walk into a government office, say, hey, I understand you've got a grant for doing this. I'm Scott. And they go, yeah, thanks for coming in, Scott. See you later. I come in and I say, hey, I happen to be the trustee of the Feeding Starving Children in Kenya Foundation. You're an international grant giving organization that focuses on health, and I would like to apply for a grant and get some money to help our project. Oh, Mr. Patton, so happy to see you. Of course, come in. Totally different way that you're being treated when you're part of a private family foundation, because you've already set yourself up as a chess player, not a checkers player. They don't want to deal with checkers players. They don't know the rules. So Google gives ad grants, believe it or not, $10,000 a month to promote your good works. And it gets better. They have a social impact program at YouTube, and they'll give $1,000 to $5,000 per month to promote your good works on YouTube. That's plus, not in addition. In addition to, and Google has a Maps program, and it gives credits for nonprofits. I have no clue what this means, but how much good can you do with 15,000 plus in free Google advertising? I would say every month. I would suggest a lot. And if you do leverage your advertising properly and it grows your business, how in a year that's like $180,000 that you just get because you're a foundation. So it's one of the reasons why we think you need to have a foundation in addition to a trust. All right. So the foundation works closely with your trust to cover all aspects of tax deferral, privacy, asset protection, while changing the world and leaving a lasting legacy. So here's the thing, right? Like, we just really want to emphasize that this is not about greed, right? I mean, it's easy for it to become about greed, like, oh, I don't know, I can cheat the tax man, I can do this, I can do that, blah blah blah. With your heart has to be in the right place, okay? And otherwise, we're not going to work with you if it's not, right? That's the bottom line. You have to be highly ethical. You have to have good morals, good values, and you really want to make a change in the world. And if that's the case, then we can proceed. So this is checkers. When you get these IRAs, Roth 401s, this is playing checkers, and this is a pet peeve of mine, right? Because you can move You can move funds out of your IRA before you retire. There are some penalties and there are some tax consequences. But the fact of the matter is that, you know, they said, oh, we will give you a little bit of money now. It's kind of like the McDonald's, right? You walk into McDonald's, you say you want a Big Mac. 30 seconds later, you've got a Big Mac, you're walking out. It's a fast food society that we live in, right? And it can be very seductive. And they say, hey, you made $50,000, put some money in an IRA, we'll give you a credit, give you money back on your taxes, which is actually just your own money. It's your own money you're getting back. And then it can accrue tax free until 72, and then you have to pull out some and you got to pay some taxes, right? And we've done the calculations. You're far better off to say, thank you very much. I see this is a bribe. I see you're trying to take advantage of the McDonald's fast foods culture that you've created the last 50 years. No, thank you. When the government tells you they're giving you money, they're giving you a small percentage of what you could be getting, right? So you're far better off to take that money, put it into your, loan it to your trust. So you still have to work on those terminologies, and let it accrue tax deferred for those years. And then when you pass away, it transfers. Your children become the trustee, and their children become the beneficiaries, and you 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 don't have the hassles of, and you don't have the disappointment, and you don't have the rule changes, right? They changed the rules, and they tried to change the rules so that you couldn't take money out of a self-directed IRA and put it into lend it to a real estate investor. It's called private money. Your money is private money. It's your money, and you give it to an investor to invest in a house. He fixes up the house. He makes some profit, and you get 9, 10, 16%, whatever it is, percent for the length of time that the money is being used. And the real estate investor industry just went nuts when they proposed this. So you have to understand that they propose things, they gauge the outrage, and they back off, right? We're going to do 100% tax rate. Everybody gets up in arms, yells, screams. They go, okay, okay, okay. It's only going to be 70%. Oh, phew, it's not 100%. That's how they manipulate things, right? So you can be pretty confident that real estate investments out of a self-directed IRA are going to be totally different in 5 to 10 years than they are now, because it was just a test. But the fact that they tested it says they're thinking about it. The fact that they're thinking about it means it's probably going to happen, and it's really going to have a bad impact on people's IRAs that are self-directed and are making good money, and they don't have to worry about the stock market jumping up and down. All right, so let's take a look at some grandmasters here. October 2006, the trustees created maybe it was lawyers, created a two-entity structure. One entity, the Bill and Melinda Gates Foundation, distributes money to grantees doing wonderful work around the world. The other, the Bill and Melinda Gates Foundation Trust, manages the endowment assets. So you notice they use the same words, except they add trust onto one, which means that people just read quickly and they don't realize, oh, there's a trust and there's a foundation hidden in plain sight. So in 2004, Microsoft paid out a $3 per share dividend. Bill Gates received a $3 billion windfall. He controls the money, he directs the money, but paid zero income tax, dividend tax, or capital gains tax on it because he pledged it to his foundation. Warren Buffett, Elon Musk, they pay very little federal income tax, even as their wealth grew. In some years, they got refunds. Hard to imagine, right? So some people think you should pay your fair share, like we should all be playing checkers. Well, Ron Paul has an annual report come out, and last January, More than 54 billion in wasteful federal government spending. Over the last 4 years, the government sent 2.8 billion to dead people. So when the money is in your hands, you can make sure that it does good work. And you know what? If you think the government deserves some money, you can write them a check and give it to them. I'm saying you have to. There's a whole big difference between voluntarily contributing to something and being coerced out of it. So when you're a grand master, what happens if the economy melts down? Now, generally, I wouldn't put this in generally, but we just had 2 years where the whole world shut down. It was a black swan event. Who thought that would happen? So who can imagine another Great Depression or the banks running out of money or all that sort of stuff? Well, if it did happen, where are you standing? Who's looked after first? All right. So in a financial meltdown, who's paid first? The FDIC insurance protects up to 250,000 in a bank account. Believe it or not, they're a trust. And there's not enough money to cover everyone. So if your trust or the trust that you're a beneficiary or a trustee of opens a non-interest bearing demand bank account and puts 250 in it, then the FDIC will look after that before it will look after anybody else. So if you wanted to get a non-interest bearing demand bank account, could you? No. It's only available to trusts. So we work with you to open those bank accounts. We show you which banks to go. The easiest, some banks understand this stuff. Some banks don't. Some banks are a pain in the butt. Some banks aren't. So we help you open these accounts so you can put your money in and you're first. So think about it for a second. If you're living in a neighborhood and nobody has any money, it breaks down and they're starving, right? I mean, if there was law and order, they'd be starving because they don't have any money, can't buy any food. You don't have any money, you're no different than them. But you happen to have 250,000 in a non-interest bearing demand bank account, and that money is good and you can pull it out. You can feed your family and you can feed your neighbors. You can make your little area an oasis of peace in a world of chaos, right? So far better to have the money than be like everybody else and not have it. So let's talk about the Abundance Group Trust and Foundation Program. So the trust is copyrighted. There are over 39,000 trusts currently in existence. It's designed by a collaboration of tax attorneys, CPAs, trust attorneys, contract lawyers over the past 12 years. It's in full compliance with trust laws, and these are them. Pause and look at them if you need to. So we have a team, obviously, with specialized knowledge and specialized results. Enrolled agents, these are federally authorized tax advisors certified by the U.S. Department of the Treasury. Enrolled agents represent taxpayers before the Internal Revenue Service for tax issues. They write opinion letters, which the IRS has to take into consideration if they go after your trust. So worst case scenario, I mean, this is all like wonderful, right? But what happens when, the black clouds roll in, the thunder, the lightning, the downstorm, the floods, and things are not rosy. Okay, so you have this trust. The IRS says, no, don't think so. You show, and it's like 20 years you've had this trust, and after 20 years, the IRS finally says, no, this is no, got to pay. Well, if you have an opinion letter, that means that you're not going to be paying interest, you're not going to be paying penalties, you're not going to be paying fees, and you're not going to be going to jail. Because, hey, and my enrolled agent said it was fine. I took his advice. Now you're telling me it's not fine, so oops. And okay, I have to pay my back taxes. I'll do that. But we have a CPA and accountant. And what do you know about trust accounting? There's a reason Bill, Melinda, Warren have accountants, same reason why you should too. We review your last 3 tax returns and we file all future tax returns because you want it done right. Now, You may have an accountant or CPA you've been using for 30 years and you want them to do it. Fine. They can take the training so that they do it right. They have to take the training to do it right. Otherwise, it's like moving the rook diagonally. And we have a tax lawyer. So this lawyer has $1 million in E&O insurance, which covers any back taxes that the IRS decides to levy should a ruling go against you. So in our bad, stormy situation, turns out, we were all wrong. You owe some back taxes. Well, the insurance covers it. So you're not really, you would have to be in the $1 billion range before you had to worry about it. And if you've got $1 billion, you can pay a couple million in taxes yourself without hurting, right? This is protecting the bottom level of our wealth. And this has never happened yet to us. So here you go. You can have a 40% capital gains tax if you do nothing. If you do it wrong, 5 years in jail plus paying all those taxes and fines. Because you may say, hey, yeah, I'm going to go get a trust. And you can go down to the library and find a book on trusts and copy it and set it all up. And maybe it'll work, and maybe it won't. But the consequences to you, to your family, to your legacy is too great if you do it wrong. And you don't just have any lawyer or accountant do the work. That's why we have a team. So setting up your foundation and trust, becoming a grand master, the hard work is done for you. We've done all the research. We've got proven documentation. It's already tested. It's ready to go. We need to customize it for your specific situation, but generally speaking, it's good. All you have to do is sign the documents and execute them. Before we get any further, I want to talk about the pipe fitter. Knowledge is power. There was this huge plant, and all of a sudden the plant stopped, and all the production stopped. And they called the engineer, and they called the maintenance department, and they checked this, they checked that, they pushed this button, they pushed that button. For 2, 3, 4 days, the plant was down as they feverishly, furiously tried to get the plant back up. Couldn't do it. Finally, the owner comes down and he's yelling and screaming and says to the plant manager, like, we've got to get this up. What can we do? And the plant manager says, well, in the town, 4 miles away, is a pipe fitter. And he's, 70 years old. But the guys think he can find it because he's done this sort of thing at other plants. The owner says, well, what are you waiting for? Bring him in. So the old pipe fitter comes in, he's got his tools, he pulls out a little hammer, and he bangs on one pipe, then he goes over to another pipe, he bangs on it, taps it, right? And then he goes over to a panel and he pushes a couple buttons and tightens a bolt, and the plant starts running again. The owner's ecstatic. The manager's ecstatic. So a week later, the manager gets a bill from the pipe fitter, $10,000. He's like, you were here like 5 minutes, he says to himself. So he sends it back and he says, please give us an itemized list of everything to justify this $10,000. So a day later, he gets another bill, and line 1 says, banging on the pipe, $10. Line 2 says, knowing which pipe to bang on and what to do, $9,990. So we want this to be quick. We don't want you to be waiting 6 months, 2 years to get your trust, to get your foundation. So we have it all set up. We need to go in, we need to adjust things depending on your specific situation, but it's all done. We have the knowledge, you have the power. And so that's the way this works. Remember, the old wealth does not want to share. Their minions watch for anyone breaking the rules, and they go after them viciously. So what will happen when you decide you want to get a trust and or a foundation, or when you meet with your trust advisor and you decide on, the details, you're going to fill out, well, before that even happens, you're going to fill out a new client questionnaire. Then we create the trust instruments with trustees and beneficiaries based on your questionnaire. We assign a compliance overseer. This makes sure that the trustee and everybody does everything according to the rules. We create the EIN number, and you use that to open the trust bank account. And then you calculate the cost basis for your assets, particularly if it's crypto, and you sell your assets to the trust. And all this documentation comes with your trust documents. And then you begin operating out of your trust. Now you're going to set up your foundation. You fill out the foundation documents, you assign roles, you get your EIN number, you open your foundation bank account, and you follow the rules. You're going to meet with your new trust advisor. You're going to meet with your new CPA. You're going to convey your assets into your trust. You're going to build a plan to maximize your tax mitigation. Well, you need to be vigilant. The second hardest part is mindset. It is not your trust or your foundation. You're a beneficiary of the trust or you're a trustee of the trust. You do not own it. We also have bi-weekly training calls. All right. There's a lot of explanation. There's a lot of support, but you need to take an active role in educating yourself. You show up at these training calls, you ask your questions, you listen to other people, you get new ideas. They become very much a mastermind after a while because we're really creating a community. And you have to understand that the mindset of the foundation, the mindset of the trust is the mindset of the old wealth. And to be honest, you've been trained to play checkers. So it's really easy for you to screw up because you think, oh, this is right, but it's not right. And if it's not right, it could collapse your structure. We accept payments in US dollars and in Bitcoin. And we're not going to get into pricing because pricing depends on your individual situation. But there are some things we just wanted to let you know. So let's say, for example, that you buy your trust with Bitcoin. And because it's a startup cost to the trust, you do not pay capital gains tax on the Bitcoin you use to buy the trust. So that's one way of taking advantage of your crypto investments. So you have a choice to pay before or after tax money or before and after tax Bitcoin. Which would you prefer?